Apple remains one of the most valuable and recognizable companies in the world, but the big question for investors in 2026 is whether Apple stock still has enough upside after its enormous rise. With AAPL trading around the $308 level, investors are looking at a company with tremendous brand power, a massive installed user base, strong cash flow, growing services revenue, and potentially significant artificial intelligence opportunities. In this analysis, we will examine Apple's fundamentals, revenue and earnings growth, iPhone and services outlook, AI opportunity, valuation, major risks, and finally my 2026 and 2027 bull base and bear case price targets. The most important thing to understand about Apple is that this is no longer simply an iPhone company. Apple has created an enormous ecosystem consisting of the iPhone, Mac, iPad, Apple Watch, AirPods, App Store, iCloud, Apple Music, Apple TV+, Apple Care, and other services. These products and services reinforce each other and create extremely strong customer retention. Once consumers become deeply integrated into Apple's ecosystem, switching to another platform can become less attractive. This ecosystem is one of Apple's biggest competitive advantages and provides the company with a foundation for generating recurring revenue for many years. Apple's recent financial performance has been strong. In fiscal Q2 2026, Apple generated approximately $111.2 billion in quarterly revenue, representing 17% year-over-year growth. The company also reported diluted earnings per share of approximately $2.01, up 22% year-over-year. These numbers demonstrate that Apple is still capable of producing strong growth despite its enormous size. The key question now is whether Apple can maintain this momentum through 2026 and 2027. My base case assumes Apple can achieve roughly high single-digit annual revenue growth, supported by services, premium iPhone demand, new products, and potentially AI-driven upgrades. The iPhone remains the foundation of Apple's business and continues to generate enormous amounts of revenue. During the first half of fiscal 2026, iPhone revenue was approximately $142 billion, showing strong year-over-year growth. The upcoming iPhone product cycle could become an important catalyst for the stock, particularly if Apple successfully encourages existing customers to upgrade. However, investors should also remember that the smartphone market is relatively mature. Apple cannot depend on unit growth alone forever, meaning future upside increasingly depends on premium pricing, new products, services growth, and increasing revenue per customer. One of the strongest parts of Apple's future growth story is services. Apple's services segment includes the App Store, advertising, cloud services, Apple Music, Apple TV+, Apple Care, and subscriptions. Services generated approximately $61 billion during the first 6 months of fiscal 2026, continuing to grow faster than Apple's overall business. This is extremely important because services generally provides a more recurring revenue stream than hardware. As Apple's installed device base grows, the company has more opportunities to sell subscriptions and digital services to existing customers. If services continues growing at a double-digit rate, it could become one of Apple's most important earnings drivers during 2026 and 2027. Artificial intelligence is arguably the biggest wild card in Apple's future. Apple has an enormous advantage in distribution because hundreds of millions of people already use Apple devices. If Apple can successfully integrate AI into the iPhone, Mac, iPad, and broader ecosystem, AI could encourage users to upgrade their devices and potentially create new revenue opportunities. However, this is also one of Apple's biggest risks. Investors increasingly expect Apple to demonstrate that its AI strategy can compete effectively with other technology leaders. If Apple succeeds, AI could create a significant new growth cycle. If it fails to meet expectations, investors could become less willing to pay Apple's premium valuation. Apple's profitability remains one of its biggest strengths. During the first 6 months of fiscal 2026, Apple generated approximately $255 billion in revenue and more than $71 billion in net income. That represents an extraordinarily high net margin for a company operating at Apple's scale. Apple's enormous cash generation also allows the company to invest in research and development, make acquisitions, pay dividends, and aggressively repurchase its own shares. These buybacks reduce the number of outstanding shares over time, which can help increase earnings per share even when overall company growth begins to slow. Apple is also one of the world's largest capital return machines. The company continues to return enormous amounts of money to shareholders through dividends and share repurchases. In April 2026, Apple authorized another $100 billion share repurchase program and increased its quarterly dividend by approximately 4%. The dividend yield is not particularly high compared with traditional income stocks, but Apple's dividend has a long history of growth. For long-term investors, the combination of earnings growth, buybacks, and dividend growth can create an attractive total return opportunity. The biggest issue with Apple today is valuation. At approximately $308 per share, Apple trades at roughly 35 times trailing earnings. That is a significant premium compared with many mature companies. The market is essentially saying that Apple deserves a premium multiple because of its brand, ecosystem, margins, services growth, cash flow, and future AI potential. I agree that Apple deserves a premium valuation, but the question is how large that premium should be. If earnings continue growing rapidly, today's valuation can potentially be justified. But if growth slows significantly, Apple's valuation multiple could contract and put pressure on the stock price. In my bear case scenario, Apple struggles with slower iPhone growth, higher component costs, weaker margins, disappointing AI execution, and a lower valuation multiple. If investors become concerned that Apple is entering a period of slower growth, the market could value the company closer to 28 to 30 times earnings. Under this scenario, I estimate a 2026 price target of approximately $255, with a 2027 target in the $270 range. This represents the downside scenario investors should consider before buying at today's valuation. My base case is considerably more positive. I assume Apple continues to generate strong services growth, maintains solid premium iPhone demand, gradually expands its AI capabilities, and continues returning substantial capital to shareholders. Under this scenario, earnings continue growing at a high single-digit to low double-digit rate. I estimate a 2026 base case price target of approximately $330 and a 2027 target around $375. This scenario assumes Apple remains one of the highest quality companies in the market, but without requiring an extreme valuation expansion. The bull case becomes much more interesting if Apple's AI strategy successfully creates a major upgrade cycle. Imagine Apple combining strong iPhone demand, double-digit services growth, successful AI features, new hardware categories, and continued margin strength. In that scenario, investors could become willing to assign Apple a premium valuation closer to 35 to 38 times earnings. Under this optimistic scenario, I estimate a 2026 price target around $400 and a potential 2027 target of approximately $450 to $500. This would require Apple to execute extremely well across multiple areas simultaneously. For 2026, my three major scenarios are relatively straightforward. The bear case is approximately $255, the base case is approximately $330, and the bull case is approximately $400. These targets represent different assumptions about Apple's earnings growth, AI success, iPhone demand, margins, and valuation multiple. The important point is that the current share price around $308 is already close to my base case valuation, which means the immediate upside is not enormous unless Apple's fundamentals outperform expectations. Looking further ahead to 2027, my bear case is approximately $270, my base case is around $375, and my bull case is between $450 and $500. The 2027 targets are based on the assumption that Apple continues increasing earnings and free cash flow while maintaining its competitive advantages. The biggest difference between the scenarios is not whether Apple remains a good company, but how quickly its earnings grow and how much investors are willing to pay for those earnings. There are several important risks investors need to monitor. The first is valuation risk, because Apple is already priced at a premium. The second is iPhone dependence, because the iPhone remains the company's largest product category. The third is AI execution, because investors increasingly expect Apple to demonstrate meaningful progress in artificial intelligence. Another risk is margin pressure from memory and other component costs, tariffs, supply chain expenses, and currency movements. Finally, China remains an important risk because Apple has significant exposure to both Chinese consumers and the Chinese manufacturing ecosystem. There are several potential catalysts that could push Apple significantly higher. A successful next-generation iPhone cycle could increase revenue and upgrade activity. Strong services growth could improve Apple's recurring revenue profile. Major AI improvements could create a new hardware upgrade cycle and potentially new monetization opportunities. Continued share repurchases could increase earnings per share, while Apple's massive installed base provides opportunities for future products and services. If several of these catalysts happen simultaneously, Apple's earnings could outperform current expectations and support a much higher stock price. On the other hand, Apple could experience significant downside if growth slows while the valuation remains elevated. If iPhone demand weakens, services growth decelerates, AI fails to generate excitement, or margins come under pressure, investors could reduce the premium multiple assigned to Apple. Even if Apple's underlying business remains strong, a valuation contraction from roughly 35 times earnings toward 28 to 30 times could produce a meaningful decline in the stock price. This is why buying price matters even when you are investing in an exceptional company. Putting everything together, I estimate Apple's reasonable current valuation at approximately $285 to $330 per share. Around $308, Apple appears fairly valued rather than deeply undervalued. The company is excellent, but the stock price already reflects significant optimism about future growth. My 2026 target range is approximately $255 to $400, while my 2027 range is approximately $270 to $500, depending on how successfully Apple executes its AI strategy, product roadmap, and services expansion. My final rating for Apple at around $308 is hold, with a long-term buy bias on meaningful pullbacks. I would become considerably more interested if AAPL moved toward the $280 to $290 range because the valuation would provide a better margin of safety. Above $300, I believe investors need to be more selective because much of Apple's future success is already reflected in the share price. For long-term investors who already own Apple, however, I see little reason to abandon a high-quality business solely because the valuation is elevated. So, is Apple stock a buy in 2026? My answer is that Apple remains one of the strongest businesses in the world, but at approximately $308, I would not aggressively chase the stock. My base case target is approximately $330 for 2026 and $375 for 2027, while the bull case reaches approximately $400 in 2026 and potentially $450 to $500 in 2027. The biggest upside catalyst is Apple's AI and next-generation product strategy, while the biggest downside risk is a combination of slower growth and valuation compression. Overall, I rate AAPL hold at current levels, but buy on meaningful pullbacks. The company remains exceptional. The key question is simply how much you are willing to pay for that quality.